This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Asian stocks are set for a cautious open after Wall Street closed out February with gains. The dollar in focus as traders brace for President Trump's tariff barrage due to hit China, Mexico and Canada this week. Chinese stock investors facing quite a pivotal week with high hopes that the National People's Congress may deliver further stimulus to counter US tariffs. And geopolitics in focus after that Trump-Zelensky White House showdown. European leaders now seeking their own coalition to secure Ukraine.
Take a look at the setup across Asia right now as we're awaiting the Japanese market opens, of course, in about 1 hour. We're seeing those futures looking higher, 0.3%. We actually saw a week of losses for the Japanese yen, but this after already 2 months of gains against the U.S. dollar. Of course, we continue to watch the BOJ tightening path. This week will be about the National People's Congress in China. We are expecting that growth target for the year to come out. The ASX 200 staggered open, not doing really much at the moment, but we continue to watch also what's happening in South Korea. That market is closed today, but of course, we have seen thousands of people protesting the Constitutional Court decision on President Yoon Suk-yeol's removal. Take a look at how we're setting up with U.S. futures at the moment. We saw that rally on the Friday session. This, of course, as we got the PCE numbers showing that inflation isn't necessarily heating up. We also heard from Treasury Secretary Scott Bessent talking about inflation slowing down over the course of the year. Crude prices at the moment above that $70 a barrel level. Of course, we continue to watch the tech sector as well, given those implications coming from tariffs that we're expecting on Mexico, China and Canada as well. Haidi.
Well, the UK has called for a coalition of the willing to secure Ukraine after any US-brokered ceasefire. As European leaders met in London, Prime Minister Keir Starmer says Britain, France and others will work with Kiev on a ceasefire plan.
Not every nation will feel able to contribute, but that can't mean that we sit back. Instead, those willing will intensify planning now with real urgency. The UK is prepared to back this with boots on the ground and planes in the air. Together with others, Europe must do the heavy lifting.
This comes after Volodymyr Zelensky left the White House abruptly on Friday without a minerals deal or security guarantees following that heated exchange with President Trump.
You're not in a good position. You don't have the cards right now. With us, you start having cards. Right now, you don't. You're playing cards. You're playing cards. You're gambling with the lives of millions of people. You're gambling with World War III. You're gambling with World War III. And what you're doing is very disrespectful to the country.
Let's bring our Bloomberg economist Alexander Isakov. And Alexander, you know, just a truly extraordinary moment when it comes to global diplomacy. But what do you see as the sort of longer-term impact of that spat on potential settlement, on potential sort of redrawing of the security lines and support that we see in Europe?
Yeah, for obviously the spat left Ukraine weaker than it was a week ago, despite the EU readiness to step in. Without US, the coalition of the willing will be narrower. And probably we are further away from the settlement today. We know that the goals of the conflict for Russia are endogenous and they depend on the level of support for Ukraine. This means that Russia and Moscow will likely be bolder in their territorial claim after this spat and will be more willing to advance kind of higher territorial claims in the potential settlement when and if the time for it arrives.
What does it mean for U.S. support eventually? Because we are expecting Ukraine's U.S. gear to start running out by the summer. So could European leaders come to the rescue?
They will, but our experience and the experience of the last year shows that the U.S. support is crucial. So if we look at 2024, we can see that the stall in the support from Congress that happened in the first half last year actually meant that Ukraine found it much harder to hold the lines of the year. So we don't expect an immediate impact. U.S. has adopted a pretty significant, chunky support package last year under Biden, but we expect that in the next 6 to 9 months, we will see that those kind of stocks are running out, and without continued and large support, we will see that Ukraine will start to experience more problems in terms of just holding the line.
You've written that the only major winner here is Putin. How much leverage does this give Moscow in this situation? And is there a realistic possibility that EU allies, global allies, can find the funding that, in the gap that will be left potentially by the US?
Yeah, for sure. Moscow is definitely a winner here. We expect that Moscow will advance both the territorial claims for Ukraine's east and south. We expect that those claims extend beyond current territorial lines of control for Moscow. As far as the funding question goes, we expect that this will be a combination of basically more spending by EU countries on defense, and part of that will be in the build-out of industrial capacity for industrial manufacturing. Part of that will go directly to fund Ukraine's financial needs. The country needs an injection of hard currency just to stabilize its external position, but also just fund the current service provision to the population. We see that the discussions sometimes touch seizing of the Russian reserves, but more often than not, they kind of find out that they already back the 50 billion euro loan that G7 provided Ukraine. So kind of tapping the Russian frozen reserves will be trickier than finding just funding new support through new debt or new taxes.
So, Alexander, as we continue to see the Trump administration's political attacks on President Zelensky, where does the Ukrainian public stand in all of this?
We don't have kind of hard survey data. There are good pollsters in Ukraine, but I haven't seen kind of hard, large-scale surveys on that question. But from the anecdotal evidence, it seems that the country is rallying around the flag and kind of consolidating around Zelensky, kind of in response to this outside criticism, which is to be expected.
If the coalition of the willing from Europe doesn't manage to come through when it comes to actual funding and security forces in that region, what are the broader sort of longer-term impact when it comes to potentially, what happens to Ukraine and what the implications are for broader Europe?
I think that the broad implication is clear that the decades-long peace dividend that Europe enjoyed is coming to an end. We expect that fiscal kind of story for Europe, which has already been dominated by the calls to stabilize the debt path, will be kind of harder to reconcile with the need to increase the defense spending to GDP to around 3%. Some countries are already kind of on the forefront of it. So countries like Poland are pretty well prepared to face this challenge, but they are in the minority. Most of the European Union countries will need to rethink their fiscal stance and fiscal space to kind of get to the 3% defense spending.
Bloomberg economist Alexander Isakov there. And on another geopolitical flashpoint, Israel blocking all humanitarian aid to Gaza after the first stage of the ceasefire expired on Sunday. It comes after Hamas rejected a U.S.-led proposal to extend the truce until mid-April. Both Saudi Arabia and Egypt have criticized the Israeli move and say aid should not be used as a weapon for collective punishment.
Well, Shery, we're watching Beijing this week with China's annual National People's Congress opening later. The economy is showing signs of some recovery momentum, but Trump's tariffs will definitely test Beijing's ability to be able to sustain that push. Bloomberg's China correspondent, Min Lo, is in Beijing. She joins us now. And so we've heard from various economists sort of really trying to manage expectations when it comes to big bang stimulus, right? Given all of the uncertainties when it comes to the impact of tariffs, counter tariffs, reciprocal tariffs, what are we expecting this week?
Yeah, so we have thousands of policymakers, including the provincial heads, the ministry heads, coming to Beijing to attend that parliamentary conclave this week. And policymakers expected to reveal the economic targets for 2025, including the growth target, widely expected to be 5% growth this year. The inflation target expected to be lowered from the existing 3% to 2%, but that's largely seen as a ceiling rather than a floor, given how low inflation is this year, the last year. And the other big target that we're looking out for is the deficit target, which is expected to be increased from 3% to between 3.8 to 4%, which would be a record high, signaling that policymakers would be pumping in trillions of yuan into the economy to address the persistent issues of the property crisis, the consumption slump, and of course, those Trump tariffs. The first round of that 10% kicking in on February 4th, and that second round of the additional 10% supposed to kick in tomorrow, a day before the NPC meeting begins. Will that factor into how the government's going to push out the budget allocation this year? Some analysts think it's not going to change the budget very much, which has been discussed and possibly set in stone weeks and months beforehand, because Beijing also favors a gradual and a very targeted approach. They may try to reserve some room to revise the budget, maybe in the middle of the year. They have done that before in 2023, also during the financial crisis. Of course, there is that DeepSeek themed rally we have seen in markets. That AI theme is going to be a priority as well. We're looking out for how policymakers signal their priority to that sector. We expect the government to continue to double down on these so-called new quality productive forces, pouring in resources to encourage private innovation. And of course, the other big piece markets will be looking out for is the consumption piece, what the government is going to do to boost consumption. That is going to be the main sort of part of the economy that will shield China's growth from the tariffs, not just from the US, but other US allies like Canada and Mexico that are under pressure from the US to match those US tariffs.
The issue with the Chinese economy is that despite all of the easing measures and stimulus, the take-up is pretty low because of the lack of confidence by consumers and businesses, right? And yet, China seems to be really in a place to keep those financing costs low in order to try to encourage the private sector to do more?
Yeah, so this is according to the PBOC Governor Pang Gongsheng. He gave an interview where he was quoted by local media saying that the central bank is going to provide or keep financing costs low, and that the government is also going to maintain market to implement this moderately loose monetary policy and loosen market liquidity as well. And this comes, as we know, liquidity has been pretty tight in recent weeks as the PBOC tried to support the yuan. And again, the PBOC governor reiterating that pledge, perhaps to reassure markets as investors are figuring out exactly when the PBOC is going to shift its stance from supporting the yuan to supporting the economy and loosening the market conditions there. Market regulators also met with a bunch of companies last week, including the likes of Geely, for example. SenseTime was there as well. And they are pledging to increase and diversify the funding sources for companies from loans, stocks, and bonds as well. And this comes as some companies have been facing trouble with securing funding, especially when funding needs the demand for that has been rising on the back of this AI rally. Many people looking to develop or to push innovation in that space, and the government is now pledging to support small and medium enterprises to help them secure more funding as the private enterprise becomes this important source of private innovation in the Chinese economy.
And Bloomberg's China correspondent Mingmin Lo there joining us today from Beijing. But coming up on the Asia trade, we'll get the dollar outlook with JPMorgan Asset Management. Fitch Ratings also explains the tariff impact on the auto sector and why they downgraded Nissan to junk. Plus, we hear from the Vanguard Group on why they don't expect a bazooka policy package out of China's NPC later this week. More ahead. This is Bloomberg.
So many different prisms through which we can watch the US story, right, particularly when it comes to what's going on in global geopolitics. But take a look at this chart, looking at what's been happening when it comes to the dollar and the underperformance of US equities, particularly compared to, say, for example, European stocks, right, which have really staged quite a recovery. We've also seen that fleeing to the bond market as well. Also taking a look at dollar bulls just slashing their wages to the lowest since before the US election. We're seeing traders there pulling back their bets on the dollar for a 6th week, and they're down by more than $8 billion compared to the prior week. So there is this kind of sense of, arguably the idea of crumbling US exceptionalism is why we're seeing dollar bears kind of seizing upon this trade and the momentum. But certainly, for whatever reason, that greenback appeal is looking like it's diminishing. And of course, the Fed and its trajectory is a big part of that argument as well. But let's get some analysis with our next guest. David Kelly is the Chief Global Strategist at JPMorgan Asset Management. And it's a pleasure to have you here in Sydney now, just, fresh off the plane, and your views are fresh as well when it comes to the ever-changing dynamics that we see when it comes to politics, and how it impacts, the macro outlook as well.
Well, yes, and I think the first thing I'd say is the US economy is still growing. I think it sort of slipped a gear as it's gone into the first quarter. If you look at the data that are coming out, particularly the survey data, there are signs of some problems here, but I think that the US is still very far from recession. It's just growing more slowly. But with regard to US exceptionalism, it's not so much politics, it's uncertainty about policies. Particularly if you take them to an extreme. If a moderate tightening of immigration, not a big issue. Some moderate, I think all tariffs are bad, but some moderate tariff increases or small tariff increases, not that huge an issue. But if you go 25% Canada, 25% Mexico, another 10% China this week, that actually is a big issue. And one of the problem is we don't know how much these policies will be pursued to an extreme. And I think it's very hard to judge that with regard to the administration. And that's, that uncertainty around that is literally slowing the economy. It's an uncertainty tax. The biggest tax that Washington levies upon the private sector is the uncertainty tax. And we've got a huge cloud of uncertainty right now about some key policies which can impact the US economy.
And I do wonder how entrenched that becomes, because you see that with China, right? The issue right now is not necessarily sort of momentum of recovery or policy, but confidence, like animal spirits. Do you see that becoming an issue for the US? Because I feel like at this point, investors have been willing to give the administration kind of the benefit of the doubt, or at least kick the can down the road a bit when it comes to worrying about these tariffs.
Well, I think markets are perhaps, I don't know if the right word is cynical or sober, but they do recognize the difference between how you feel about somebody politically and what actually impacts profits, interest rates, and stock returns in the long run. And so far, so long as the US economy keeps going and you don't have a big pickup in inflation or a big slowdown in growth, then I think that's why the US equity markets look supported, particularly because other parts of the world also have some issues. But I think it's going to be very important to watch what happens over the next few weeks with immigration, particularly with tariffs, but also on the tax bill. I think that we'll learn a lot in the next few weeks about whether they're going to try and push all these tax cuts and spending cuts into the economy. And the problem is the spending cuts come first, the tax cuts come later. So that could also slow the US economy.
The other parts of the world that you mentioned that have issues, of course, one of them is China. We are expecting the National People's Congress in Beijing this week. What sort of measures do you expect to see that could potentially lengthen the rally that we've seen recently because of all of this optimism over DeepSeek and cheaper AI?
Yeah, well, I think I'm not sure exactly what else the Chinese government can do here. I think it really is an issue of confidence, as we were just talking about. I think the problem is partly housing, but it's also really a question of commitment to global engagement and commitment to helping businesses. I think Chinese consumers, but also Chinese business people, need to become more confident. So I think the more that the Chinese government is able to instill that confidence, the better the economy will do. And so, obviously, trying to work out some sort of trade agreement with the United States to try to avoid a tit-for-tat tariff battle would also be very important for that.
When it comes to confidence, what are we expecting in terms of those sectors in the markets like tech that have seen a little bit of a revival given President Xi Jinping's renewed embrace of the sector?
Well, that's right, and I think we've had a sort of a premium for U.S. tech relative to other tech both in Europe and tech in China, and I think that we were talking about American exceptionalism. I think as the U.S. runs into some issues, and when obviously U.S. tech companies could be the target of retaliatory tariffs, I think that's taking a little shine off the U.S. tech story. But also, I think DeepSeek is really a good way of talking about the fact that, if you have like it's as in the .com boom initially back in the late 1990s, the early leaders are not necessarily the eventual winners. And so if you can find ways of using cheaper ways, smarter ways, more efficient ways of utilizing technology, of building technology, then you're going to be the winners. And I think that what this, what DeepSeek is teaching us, the lesson from that, is that there are perhaps better ways of doing AI. And I think that's obviously this is something the Chinese government will want to encourage.
And I think Shery was sort of also going to the bigger question of, we talked a little bit about, I guess looking for diversified options for clients at this point, particularly if there's some concerns over the US. Our question of the day actually asks, will European stocks go on outperforming the US? If you look ex-US, what's compelling to you now?
Well, they certainly could. I mean, I think something that's has been a little bit below the radar but shouldn't be, is we got a very market-friendly result in the German elections, because it could have been that you needed to have a three-party coalition which would have included either the left or the Greens or the smaller right-wing party that was very fiscally conservative. But in fact, by having a centrist, right-centre, left-centre coalition, you're able to avoid those extremes. Now, they still have an issue with the debt brake, and so they need to find a way of getting rid of that very silly, to be honest, rule. But I think having centrists running Germany will help, and I think perversely, the withdrawal of America's commitment to Ukraine is actually, I think, very important for Europe, because it really is reminding Europe that they need to build a defense industry themselves. And so not only, you may have a willingness for Germany to spend more fiscally, but you may also have a compelling need to do so. And I think that those two things could really help Europe, grow faster. And European stocks are extremely cheap relative to US stocks. So I think that certainly is an area where people ought to think about in terms of diversification. It's not just what's going to outperform in a good year. It's what's going to outperform in a bad year. If you have a market crash, which could of course happen, you could have a bear market. Chances are, you never know when a bear market is going to occur, but you do know where. It's going to start and be focused on the most speculative sector. And that's why I think it's important to diversify beyond just the US.
David, really great to have you with us. David Kelly, Chief Global Strategist at JPMorgan Asset Management. More ahead on the Asia trade. This is Bloomberg. US Treasury Secretary Scott Bessent has criticised what he describes as shocking behaviour from Ukrainian President Vladimir Zelensky at the Oval Office. Bessent told us that it will take a major effort to repair strained ties.
Clearly, it's very difficult to do an economic deal with a leader who doesn't want to do a peace deal. And I will tell you, I was sitting 3 away from President Trump or President Zelensky, and this has to be one of the great diplomatic own goals in history.
If Mr. Zelensky called back right now and said, I'm sorry, I want to put it back together, what would he have to do?
I don't know. Mr. Zelensky and his team were taken out of the Oval, and they kept coming back with that message, and then they left the White House. And it's going to take a lot of repair. And, David, the real tragedy here, maybe things can be repaired with the administration, but I don't know how the American people are going to feel. And more importantly, the the economic deal, the meeting today, the real purpose was to show that there was no daylight between the Americans and the Ukrainians. So President Trump's idea was to show that with the economic deals, to show that we're more intertwined, and that would be a symbol to the Ukrainian people, to Russian leadership, and to the American people. And President Zelensky blew that up today. I'm not sure what he was thinking.
As I say, you were the point person, really, for the administration on the economic deal. We all thought on the outside we were very close. In fact, I think many of us thought there'd be a signing today, that we'd have some form of economic deal today. Were we as close as those of us on the outside thought? Were you surprised?
Again, I was shocked that President Zelensky would come into the Oval Office, behave like this, speak to the president, speak to the vice president, but more importantly, disrespect the American people like this. I know he's under a great deal of stress. He and I had a very heated exchange in Kyiv. I think the same thing may have happened between him and Vice President Vance and Secretary Rubio in Munich. And, to come in and behave like this was unacceptable. And look, I mean, what better runway did he have that President of France, Emmanuel Macron, in the Oval on Monday? Yesterday, we had a fantastic meeting with Prime Minister Keir Starmer from the UK, and then President Zelensky today. I mean, you could not have asked for a better arc. And he walked in, and I'm not sure what he was thinking.
Many of us have been in heated negotiations, not at this level, but still heated negotiations where people pound the table, they may walk out the door and things like that, and it's actually part of the negotiation. Is that what we saw today, or was this a more fundamental rupture?
David, you don't do a negotiation with the President of the United States in public like this. That we were scheduled to have lunch afterwards, and that perhaps he could have brought up some of the points. Instead, he chose to let things go into a downward spiral on worldwide television. And again, I keep coming back to the disrespect of the American people. It was one thing for President Zelensky and I had an extended, heated negotiation in Kyiv. But we were going to get this economic agreement done. But when you bring it out to the public like this, we'll see if there's any coming back.
U.S. Treasury Secretary Scott Bessent speaking exclusively with Bloomberg's David Weston, and that was a wide-ranging conversation. Of course, we also touched on the economy, inflation as well, Haidi. And the Treasury Secretary is saying that he expects inflation rates to slow down over the course of the year, especially given that he expects yields on the 10-year to come down. He also expects U.S. home mortgage rates to come down as well. Remember, the housing market in the U.S. has been stuck because of high prices. Also, mortgage rates now, the 30-year fixed rate above 6%. Inflation, a key concern. We've had a CBS News poll saying more than 80% of respondents saying that inflation should be a high priority, but they're only 30% think that President Trump is actually prioritizing it a lot.
Yeah, what's quite interesting is that, obviously on a lot of the sort of the campaign policy lines that he was voted in on, for example, clamping down on immigration, about 2/3 in that CBS poll giving him credit for reducing migrant crossings at the US-Mexican border. The takeaway, though, is that the approval rating is left in positive territory, but interestingly, CBS saying it's more closely divided than a couple of weeks ago. So really where the economy heads from here is going to be critical when it comes to maintaining sort of that support level, right? But a lot has to really do with the potential tariff implications. Of course, they're kicking in when it comes to Canada, Mexico and China this week. And as we heard from JPMorgan Asset Management's David Kelly earlier saying, it really is a critical week in terms of how we see these tariffs playing out, and will obviously take longer to see if that inflationary, potentially stagflationary, as some economists have been saying, impact will be felt. But we did see, Bloomberg Economics saying that consumer-driven index decreasing really largely on these concerns over the economic outlook and the inflation outlook as well. Let's take a look at some of the other stories that we're following this hour. And corporate insolvencies in Singapore soared last year to the highest level since 2010. The government says as many as 307 firms closed up in 2024, up from 201 the previous year. Singapore expects GDP growth to come in between 1% and 3% this year, down from 4.4% in 2024. China's ambassador to Australia has warned that a decision to ban AI app DeepSeek from government systems and devices risks further politicising trade and technology ties. The ban was implemented by Australia's government in early February, citing national security grounds. The move could sour recently stabilised bilateral ties.
Now, over in South Korea, thousands of people protested in Seoul over the weekend, divided over President Yoon Suk-yeol's impeachment as judges deliberate on his ouster or reinstatement. For more, let's bring in Bloomberg East Asia government editor John Herskovits. And John, it was really interesting to see that at the beginning, after President Yoon imposed martial law and then, of course, lifted it, most South Koreans were against that move. But now you're seeing this core of conservative supporters loyal to President Yoon.
Yeah, you were seeing them, and they turned out in force. There were tens of thousands of them who turned out for these protests. But the basic poll numbers have been consistent. The majority of South Koreans see Yoon, an impeachment as appropriate for Yoon. While the numbers decreased somewhat, it's still the majority. The interesting thing is that neither political party has really picked up a lot of steam in the polls. The opposition party against Yoon is running even with Yoon's own political party. So while people are still supporting of the move to impeach him, it hasn't really changed the political balance all that much in terms of support between the conservative and the progressive parties.
So who exactly are we talking about being part of these protests? Because I'm assuming, especially when it comes to those loyal to Yoon Suk-yeol, they probably gathered around the Gwanghwamun Square. Is that what usually happens?
Yeah, it was interesting because we have a lot of echoes with U.S. protests that are going on. The protests some of the bigger protests were organized by conservative pastors, and they appealed to they use things like Stop the Steal. A lot of the people in the right wing are seeing a deep state of the left in places of the economy, elections, and relations with North Korea. So the right is accusing the left of close relations with North Korea. But yeah, that is the concern. This Stop the Steal, the echoes of the U.S. are part of the right-wing movement. On the left, you're seeing the politicians, lecturers of the left who are there and opposing Yoon. But the right ones are, it's quite an interesting dynamic that's going on.
It's a critical time for global diplomacy, right? Have we seen this leadership vacuum, this ongoing political uncertainty impact South Korea's ability to be able to engage with the new Trump administration, for example?
It's really been difficult because the leadership vacuum has made it difficult for South Korea to come up with Trump when he's looking at imposing tariffs. There's economic uncertainty, and South Korea has an export-dependent economy. So much relies on the U.S. So this vacuum has hurt South Korea in terms of its economy, in terms of its diplomacy, and also this persistent threat from North Korea. The interesting thing, like a year ago, for the same day, Yoon Suk-yeol was at arguably one of the peaks of his power, where he talked about getting closer to Japan, bringing security relations with the U.S. and Japan even closer, and rebuilding the economy. So 1 year later, he is on the verge of impeachment, with the Constitutional Court deciding whether he stays in office or goes.
Our Bloomberg East Asia government editor John Herskovits there. And as we embark on a really critical week for markets, we're full of risks from the geopolitical to, of course, economic, be it you're looking at US jobs numbers, be it you're looking at the tariffs that are impending when it comes to Canada, Mexico and China. There's also the National People's Congress kicking off in Beijing as well, with some expectations or hopes, perhaps I should say, when it comes to further policy stimulus and support measures for the Chinese economy. This is a picture as as we look across just about 40 minutes into the start of trading here in Australia. It is looking a little bit brighter. We have had a pretty difficult run lately when it comes to Australian stocks just coming off those record highs, but we are seeing a bit of an uptick at the moment, about 0.5% higher. Futures also looking sort of a little bit more choppy given all of the uncertainty, Shery.
And Haidi, still to come, we discuss Nissan and the broader auto market with Fitch Ratings, who is now seeing dwindling options for survival for the car maker. They cut the car maker's debt to junk, and as this broader auto sector is now facing tariffs as well. This is Bloomberg. Take a look at how we're setting up for the Japanese market opens. Of course, we've been watching the Japanese yen very closely. 2 months of gains against the greenback. We saw a little bit of weakness in the last week, but yen positioning by asset managers the most bullish since 2021. We'll be watching JGBs as well. They actually rose. We had some safe haven demand, not to mention Tokyo inflation slowing more than expected, and you have those expectations of Bank of Japan tightening. At the same time, of course, we continue to watch the tariff threats and how that will impact the broader markets, especially when it comes to the auto sector. Those tariffs on Canada and Mexico and China expected this week. We've been watching one car maker in particular, Nissan, and this, of course, after the merger conversations with Honda seem to have broken down. We continue to watch whether there's any potential for that, but Nissan's credit is now graded as junk by all three major agencies. Fitch last week cut and downgraded the car maker, citing weak earnings and uncertain prospects for recovery. Joining us now is Satoru Aoyama, Senior Director of APAC Corporate Ratings at Fitch. Satoru, great to have you with us. So what do you think is happening at Nissan that prompted your downgrade?
First, BB Plus is the highest rating in the non-investment grade categories, and Nissan is not facing life or death situations. Having said so, there are three things. Number one, macro uncertainties. Tariff risk. Higher than expected inflation rate, higher than expected interest rate, and expected slowdown in the US economies. And number two, reputational damages. We're seeing the massive news flow of the negative news on Nissan. And third thing is that the downward earning trend, meaning Nissan doesn't have a buffer to absorb any unexpected downturns.
It's interesting that you mentioned first that they're actually in a strong position when it comes to their balance sheet. They have solid liquidity. But what is happening during the restructuring process right now that gives you cause for concern when you have, as you mentioned, the global macro environment and their exposure to the U.S. market?
It's a good point. As of today, it has a solid liquidity, very strong balance sheet, but it doesn't mean that the company can preserve this for the next 12 months. That's one of the reasons why we gave a negative rating outlook. Having said so, it's a very solid company. Financial management has been very conservative. It's just that the top line is not catching up to what the management promised to the market.
What do we need to see in terms of alliances or cooperation with other car makers in the future for them to stay afloat?
Which is a very good point, because in fact, we're a bit relaxed after this announcement of the merger discussions. It's gone. It's quite concerning, because the thing is, Nissan as well as Honda, they become very small global auto OEMs. You see, Toyota, 11 million, Volkswagen, 10 million, Stellantis, GM, 6 to 7 million, Hyundai, 7 million, global sales unit. Honda, 4 million, Nissan, 3 million. They're very tiny. It doesn't have enough scale to allocate resources for the next innovations.
So, at what point does this become kind of an existential problem for Nissan, right? That they need to start worrying about survival?
You see, and so, once again, Nissan is not facing life or death situation. It's not the existential risk. It's more like a issue to manage the communication flows, issue to manage the sales, especially the new models in North America, and cost reductions. See, next not next. I mean, the next 6 months to 9 months, company will focus on the cost reduction, mostly come from the fixed cost, like layoff and the factory closures. Following that, we need to make sure that the company can achieve operational efficiency and growth of the top lines. If they cannot achieve this, then your question will come.
If they need more than just deeper restructuring measures, right? Is this a pressure that you see sort of across the broader auto sector? Do you think further consolidation is something that we can expect to see?
You see, Honda, Nissan, as well as many other Japanese, well, actually, the thing is, except the Honda, Nissan, and Mitsubishi Motor, all the Japanese OEM are Toyota's allies, the broad Toyota's alliance. So these two companies, plus Mitsubishi Motor, they are the remaining global auto OEM without the scale. So the alliance still exists, and which is very important, and I think this is very critical, and you are right. If they cannot achieve meaningful results through the alliance, it can be the existential problem in like 10 years or 15 years.
More immediately right now, those tariffs on Mexico and Canada to be implemented this week. We also have global tariffs as well. Who is most exposed?
It's a good question. Nissan still, Honda had the largest exposure to Canada and Mexico. Basically, they import to U.S. Import to U.S. Nissan, Toyota, they have a relatively large export to U.S. So you see, now it's a very extensive issue. That's why we don't really have the risk is there. We just don't know exactly what kind of shape this tariff will impact.
Very complicated layers of tariffs right now, and we are not even sure if we're going to get a last-minute deal as well, right? Satoru Aoyama, good to have you with us, Senior Director of APAC Corporate Ratings at Fitch. Catch Japan Ahead every Monday at 8:40 a.m. If you're watching in Tokyo, subscribers can watch live on the terminal using the TV Go function. This is Bloomberg.
The United States is pulling funding from the Gremlin. It's an organisation which monitors infectious diseases at a time where the nation is seeing surging measles cases and a growing risk of a pandemic strain of bird flu. Our senior editor, Jason Gale, joins us now. So, Jason, I don't suppose there's ever really a good time to pull back when it comes to public health funding, but this at the moment certainly seems very precarious.
Yes, Heidi. Right across the board, we know that pandemic threats are only increasing around the world. And in the United States in particular, we have the H5N1 bird flu virus that is spreading in dairy cows in particular, wild birds, poultry, and occasionally getting across into humans, where there is a real risk that it will mutate and cause the next pandemic.
What are we seeing internally, domestically, within the Trump administration when it comes to the CDC under Robert F. Kennedy Jr. as well?
Well, under the appointment of this new secretary, Robert F. Kennedy Jr., we're seeing cuts to the CDC, job cuts to the NIH, funding cuts to research. There will be changes in the way drugs and vaccines in particular are approved and who is going to be doing the approvals. All of this is raising a lot of concern about how prepared the US and the world is to deal with future infectious threats.
How concerning is a threat of bird flu at the moment?
Yeah, so the bird flu virus is circulating still widely across the US, across the world, in fact. But in the US, it's spilling over from wild birds into poultry and into dairy cattle. The dairy cattle are spreading it among themselves, and we've seen now almost 3/4 of the dairy herds in California infected. And then the virus is getting across to people. And the real risk is that people will be infected with both bird flu and human seasonal flu, and that will allow the virus to reassort into something that could be way more infectious and could start spreading from human to human and be the source of the next pandemic.
Oh gosh, don't talk about another pandemic. Jason, what are we seeing in terms of global cooperation right now on outbreaks like this?
Yeah, so I think what we're seeing right now is we knew that the US was a really important player in scientific research and in global health, but we didn't appreciate until now that that some of these instruments are being pared back, just how important it is. And we're seeing, like in Africa, with disease surveillance, with aid, with the detection of infections, it's really being hampered by the fact that we don't have this collaboration between USAID, the CDC, and the WHO investigating threats.
Our senior editor Jason Gale there on just the potential impact when it comes to US withdrawal of public health funding, both domestically and, of course, internationally as well. Let's get you a look at, really, we're sort of on the precipice of what could be a pretty choppy week of trading sessions, as there's really myriad risks. Of course, trade tariffs is one of them, the kicking off of tariffs against Canada, Mexico and China this week, as well as the National People's Congress getting underway in Beijing this week as well, with some hopes of further stimulus and support measures for just a nascent recovery that we've seen in the Chinese economy and how that economy can potentially counter that threat of US tariffs as well. Also US jobs data, as well as more questions over the kind of trajectory for the Fed, given some of these inflation uncertainties. At the moment, we're seeing upside when it comes to trading here in Australia, about 0.5% to the upside, just about 55 minutes into the start of that trading session. We're seeing most sectors there in the green, a bit of a lag when it comes to utilities, but some strong gains for real estate as well as some healthcare stocks there as well. But the market open in Tokyo is next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens after another rally on Wall Street last week, Haidi. Despite the geopolitical concerns, of course, we saw the White House clash between Presidents Trump and Zelensky. At the same time, we're watching potential haven moves with the Japanese yen continuing to strengthen.
Just an extraordinary moment of global diplomacy, right, that we saw. But again, like so many risk factors going into this trading week, you mentioned, of course, some of these tariff threats. We do have the NPC kicking off in Beijing as well, possibly more policy support from Beijing for that recovery that we're seeing in the Chinese economy. We're looking at US jobs, a pretty difficult situation for global central banks, including the Fed right now, Shery.
Yeah, given that landscape, no wonder we have seen JGBs gain ground in the previous session. We'll continue to watch the 10-year yield at the moment, given, of course, that we got slower inflation coming from Tokyo as well, and we continue to watch that BOJ tightening path. The yen holding at that 150 level, a little bit of weakness against the US dollar, but this, of course, as we've seen, 2 months of gains against the greenback already. We continue to watch the Nikkei up 1.3% at the moment. We're watching those sectors like automakers, semiconductors. Of course, we mentioned the tariffs that are going into effect this week on Canada, Mexico, as well as China. South Korea away on holidays, but do watch out for political risks over there as well, because we saw thousands of people protesting over the weekend about the Constitutional Court deciding whether to keep President Yoon Suk-yeol after his martial law declaration, Heidi.
Yeah, take a look at how we're trading. We're about an hour into the start of the session here in Australia. Some pretty solid gains there when it comes to some of the leadership that we continue to see from the likes of healthcare, from the likes of the real estate stocks. A little bit of a laggard when it comes to utilities, but broadly we are seeing some pretty reasonable gains. We're also watching the Aussie dollar at the moment, 62.18. A little bit of upside as we saw really these bets against the US dollar continuing to build. Right, is where the question of whether sort of the Fed fade of the US exceptionalism story, and perhaps that continues to benefit certainly some of the Asian currencies, as well as, of course, what we see in terms of the outperformance in ex-US risk assets, the likes of Europe, for example. Watching these bond markets, as you say, Shery, we have seen that flurry of sort of haven demand going into bond markets and treasuries, and whether that will continue given how much risk is building up for this week.
Heidi, let's bring in Kieran Calder, head of Asia Equity Research at UBP, to discuss all this. Kieran, great to have you with us. Heidi just mentioned the building of risks around the world right now, whether geopolitics or trade as well. Why are we continuing to see markets rally despite all of this?
Yeah, well, certainly some extraordinary TV over the weekend. So I think one of the things you're seeing this year, as you mentioned, is a bit of rotation away from 2 years of outperformance from the U.S. into markets, particularly Europe, that were extremely cheap, and where the situation is changing. So we think, fundamentally, obviously, Europe is getting ready to stand up for itself, and this sort of reflects a structural change, we think, within Europe, and that's driven some of the, we think, rotation away from the U.S. so far this year.
Is that rotation also going to go into China?
So I think China is a difficult one. So obviously we've got the NPC coming up. For us, we kind of have a structurally still negative view on China. If the issues there with property and real estate, et cetera, were easy to fix, they would have been fixed long ago. We think there is an opportunity in tech where obviously, the tech is kind of back, and especially reflecting Jack Ma coming back. So we think there's a positive added bias there. Also, those companies are extremely strong after the restructuring they've done over the last couple of years. But for China overall, we're still a bit negative. I think we also have to remember that there is a possibility that Trump tries to do a grand deal with China, and I think that's kind of maybe the dark horse scenario.
Kieran, I wanted to get your sort of a bit more expansion on your views on Europe, right? This is our question of the day, which kind of asks how much further we could see the advancement of European stocks versus the US. And, really, so far they've really left their US counterparts in the dust this year, right? The Euro Stoxx 50 about 12% year to date, outpacing that 1.2% gain for the S&P 500. So do you think there's further sort of fundamental drivers in this rally? And is it more to do with the recovery in Europe, or is it more to do with this idea of sort of perhaps fading US exceptionalism because of the policy uncertainty?
Well, I mean, so we think it's a bit of both. So if you look at, so first of all, Europe was starting from extremely cheap valuation, especially relative to the U.S., so that's kind of the starting point. If you look at the sectors that have led, it's been banks and insurance. So banks, European banks, have valuation-wise pushed past the post-GFC highs. So we're now pushing towards 1.1 times price to book for European banks. So is that warranted? Over the last, let's say, 5 years of zero interest rates, most of the banks in Europe have restructured. We're now potentially going to see some consolidation. Let's see what happens with UniCredit in particular. But there is a story there around higher ROE and therefore higher valuations with the banks. But the problem with Europe has always been slow growth. So I think at some point we need to see better growth out of Europe and better coordination, and maybe that's being forced upon them by what's happening around Ukraine and the U.S. And the meetings over the weekend in London, a bit of solidarity amongst European countries, even the countries that are no longer Eurozone. So to answer your question, we think there's probably some further upside, but a lot of it's already in the price.
The underweight China, I wanted to get back to that, and broader EMs. Is it underweight EMs as a proxy to China, or is it sort of the broad implications of what global tariffs could mean for some of these markets?
Yeah, well, I think if you look at EM, it's mostly China for a start. So as we talked a little bit, we kind of have a structurally negative view on China outside of tech. If you look at the other major countries within EM, so India, which is having a bit of a tough year, but we would look to probably add on weakness, and then some of the Latin American countries, Mexico, obviously a target of trade tariffs, so that's a little bit difficult there. And then some of the smaller EM countries, the idiosyncratic risk is maybe a bit too much for us as a private bank. And that's kind of, that's most of EM. So this kind of wraps up, why we have a negative view both on China, excluding tech, and the rest of EM.
Kieran Calder, good to have you with us, Head of Asia Equity Research at UBP. We're watching crypto assets at the moment. Of course, we saw that Trump-fueled rally when he talked about having really these cryptocurrencies as a strategic crypto reserve. That would include Bitcoin, Ether, Solana, XRP, and ADA tokens. And we saw that huge rally in the likes of, say, even Cardano gaining more than 50% at one point. We're seeing a little bit of downside when it comes to Bitcoin in today's trading session, down 0.5%. And you can see those crypto-related shares also a little bit mixed. We don't have much detail coming from the Trump administration on how the purchases will be funded, how much the government will buy. But still, it does show Trump's commitment when it comes to the crypto industry and what he hopes to see in the sector. We do also have breaking news out of Japan. We are getting the latest on JX Advanced Metals. They're set to price their IPO range at 810 to 820 yen per share. The company is seen valued at 800 billion yen after the share sale. JX mines and refines metals and generates about a third of their operating income from semiconductor materials. And right now we're hearing that they have set their IPO price range at 810 to 820 yen per share. We have more ahead on the Asia Trade. This is Bloomberg. China's annual National People's Congress opens later this week, with the economy showing signs of momentum. But the Trump tariffs will test Beijing's ability to sustain that push. Our China correspondent Min Lo is in Beijing. Min, so what sort of expectations do we have when it comes to a potential stimulus package, given, of course, the trade tensions that we continue to see?
Yeah, so we're looking forward to Wednesday when NPC kicks off, and that's when Premier Li Qiang will deliver the government work report, where he will give us his assessment of how the past year went and also look ahead to the next year and deliver some of the economic targets that investors and bankers have been looking out for. The broad consensus here is that the growth target is still going to be set at 5% or around 5% to give them a bit of a wiggle room there. The inflation target likely to be lowered from the existing 3% to 2%. But that's, again, likely to be seen as a ceiling rather than a floor, because we're still a long way from hitting that 2% or the 3% target last year. And when it comes to the deficit target, that's expected to be expanded from the existing 3% to maybe 3.8 or even 4%, and that would potentially make it the highest on record. We're also looking out for quotas when it comes to those bonds, special sovereign bonds as well as local government bonds. Some analysts expecting at least $1 trillion more in special sovereign bonds that could be earmarked for special projects, infrastructure investments, local government bonds as well, that could be used to fund, for example, the consumption upgrading program to support domestic consumption. So we're looking out for what sort of policies and how aggressive the government is going to be to boost domestic spending, for example, by strengthening the social safety net, to encourage more discretionary spending by migrant workers, by including them into being able to participate in public public services, medical care in the places that they're living in, for example. And of course, there is also the broad priority that we're looking out for what the government will signal in terms of where they will channel resources, which sectors are in favor and which sectors are not. So obviously there is the AI theme, the government presidency last week meeting with its private sector leaders, perhaps signaling more support for the private sector economy as well, and pouring resources to double down on that self-sufficiency push as well.
We've also seen Beijing again pledging to keep financing costs low for private companies, to loosen up credit conditions. But I do wonder, typically there hasn't been a lot of demand for these funds because of how repressed sentiment is. Could that be about to change when it comes to more enthusiasm for AI and tech funding?
Yeah, I think the weakness in demand is coming especially from households. You look at demand for mortgages, demand for short-term loans have been very weak. Corporate loans as well has been pretty weak, but because of that AI rally, there has been an increase in developmental activity in that space. And what the PBOC Governor Pang Gongsheng said that was reported this morning by local media isn't exactly new. He once again pledged to lower financing costs for companies. We already heard that when President Xi met with the private sector leaders. There were other measures that were pledged, such as putting an end to these random penalties and investigations and seizures of private companies. PBOC Governor also pledging to loosen liquidity in market conditions and also to implement that moderately loose monetary policy. And once again, he's reiterating this because markets had been concerned that the PBOC has been supporting the yuan, tightening liquidity conditions, withdrawing liquidity through most of its daily market operations in January. So when are they going to shift to that looser monetary stance is something that investors are watching for. And yes, we are expecting to see triple R cuts, interest rate cuts sometime this year. Question is when and how fast the pace is the PBOC going to move? And perhaps they're still at this point in that holding pattern now as they wait to assess the actual impact of these tariffs from Trump, given that there are new tariffs that are going to be unleashed tomorrow, additional 10% on these Chinese goods. So tomorrow is a very important day that we want to look out for because Beijing could unveil their own set of countermeasures to these tariffs from Beijing, from the US.
Bloomberg's Min Lo there in Beijing ahead of this week's NPC. Well, the UK has called for a coalition of the willing to secure Ukraine after any US-brokered ceasefire as European leaders met in London. Prime Minister Keir Starmer said that Britain, France and others will work with Kyiv on a ceasefire plan.
Not every nation will feel able to contribute, but that can't mean that we sit back. Instead, those willing will intensify planning now with real urgency. The UK is prepared to back this with boots on the ground and planes in the air. Together with others, Europe must do the heavy lifting.
This comes after Vladimir Zelensky left the White House abruptly on Friday without a minerals deal or security guarantees following a heated exchange with President Trump.
You're not in a good position. You don't have the cards right now. With us, you start having cards. Right now, you don't. You're playing cards. You're playing cards. You're gambling with the lives of millions of people. You're gambling with World War III. You're gambling with World War III. And what you're doing is very disrespectful to the country.
Well, Bloomberg's Michael Heath joins us now, and even just, we've obviously seen that video so many times, just an extraordinary moment in global diplomacy, right? We've since seen globally the support rally for Ukraine and for Zelensky, and obviously domestically as well. But for Europe, could this actually be, a really transformative moment if they can gather the funding to back up that support?
Yeah, Heidi. I mean, look, I don't think Europe has much choice. What was sort of there, I mean, it was almost like reality television coming to the White House. I mean, sort of extraordinary scenes where a person who's been feted as a hero internationally for 3 years is humiliated live on television, and a dictator that invaded a sovereign nation without any sort of provocation is seen as a reliable partner and whose word can be trusted. So yes, it is extraordinary. As for Europe, I don't think it has any choice. I think they know that they have to take a stand here, and they are going to have to support Ukraine because Europe understands that with Russia, you show weakness, you end up having to fight further along the line. And that's always been the case with bullies and dictators, as we've seen through history, and that's the case now. So what the British Prime Minister, I think, is doing, and he's very clever. He's keeping the door open to the US, hoping that they can get air support or intelligence or these sorts of things. But it's really going to be up to Europe to take a stance. And you've even seen this situation where Canada's now starting to talk with Europe as well. Canada's obviously part of NATO too, but you may well come and you see this, new configuration of like-minded nations, of nations that will uphold democratic values, that do believe in a world order of laws and systems and that sort of thing. But I think that Friday it was almost like pulling the band-aid off kind of thing, that Europe can't turn to the US now. Europe is going to have to rely on itself, and of course it brought hoops of joy from the Kremlin, no question.
So, how easy is it for the President of the United States to really withdraw support for Ukraine, despite what Washington might think? And how much does Ukraine need these equipment coming from the United States?
Shery, I mean, it needs it a lot. Europe can provide quite a few, quite a few things on the military front, but there's gaps that can only be filled by the United States. And the last support that President Biden had issued just before he left, that will run out in time. And look, how quickly Europe can step in is a real question. And based on what we saw on Friday, I mean, the US, there seems no inclination to support Ukraine further. And even Ukraine supporters among Republican parties, people like Senator Lindsey Graham, who was slapping Zelensky on the back at the Munich conference, sort of turned on him, in social media posts after. I mean, so the lining up of the Republican Party behind President Trump's view seems to be, very, very quick. So I don't think that Ukraine can rely on it much at all. And they haven't signed this minerals agreement. But the interesting point here is that from the reporting that our colleagues in Kiev has done is that basically the way that President Trump treated President Zelensky, Ukrainians took that as a personal insult, and they've actually solidified behind him. So Ukraine will fight on. I mean, when people say Russia is a tough nation, I mean, Ukraine and Russia share a lot of similarities, and the Ukrainians are just as strong as Russians are.
Bloomberg's Michael Heath there with the latest on all of those geopolitical tensions around Ukraine, and those expectations of perhaps more European defense spending have sent the euro higher, continues to gain ground against the US dollar at the moment, as you're seeing also European shares, futures pointing to the upside. We had already seen 10 weeks of gains for European stocks, and despite the geopolitical news, despite the trade tensions as well, European shares have had a strong start of the year. We've continued to see upbeat corporate earnings and bets on improving economic growth as well. Haidi.
Shery, Finland's president says the only path to a ceasefire deal in Ukraine is to get Trump and Zelensky back on talking terms and seated at the negotiating table. Alexander Stubbs also told us that he's proposing a three-phase plan towards reaching peace.
Well, sometimes public diplomacy doesn't work, but in these kind of situations, I think you have to be Finnish. Take a deep breath, take a cold bath, sauna, breathe, get back to the negotiating table. These things happen sometimes.
What's the way forward?
The way forward is to get President Zelensky and President Trump to communicate again and to get a minerals deal. I think that'll probably be a tipping point for a bigger deal towards a ceasefire and then towards peace negotiations. I don't think we are as far away as probably the public indicates.
We heard from the NATO Secretary General that it is up to President Zelensky to repair his relationship with President Trump. Do you agree?
I think it always takes two to tango. Sometimes what happens in marriage or in other types of relationships, you sort of go into your corner and sulk, but you have to come out of there, have a conversation, shake hands, and move on.
And do you think we're close to that point?
I hope we're moving. I mean, I think one of the things that we're trying to do in London with this summit organized by British Prime Minister Keir Starmer is to get a reading of the 3 meetings that were held with President Trump last week, take the best parts of it and find a way forward.
What does Europe need to do now, though?
We need to have a plan. One of the problems is that we have sort of this cacophonic diplomacy. We have different types of groupings and organizations dealing with different types of things. If we want to have an initiative, there needs to be a European and Ukrainian peace plan with which we can then talk with President Trump and later on with President Putin.
What is your message today?
My message today is that we need a plan which should have 3 phases. First, what do we do before the negotiations start? In other words, put Ukraine into a position of strength, give them military, political, and financial support, and put more pressure on Russia, sanctions, and use the frozen assets. And then find some kind of security arrangements where Ukraine takes the lead, Europe supports, and the US provides the backstop. That's stage number 1. Give that as a plan. Stage number 2 is a ceasefire, and stage number 3 is actual peace negotiations. We just need to put things together, and I think we are in the right direction to do that.
That was the Finnish President Alexander Stubbs speaking to Bloomberg's Francine Lacroix in London. And on other geopolitical news, Israel blocking all humanitarian aid to Gaza after the first stage of the ceasefire expired on Sunday. It comes after Hamas rejected a U.S.-led proposal to extend the truce until mid-April. Both Saudi Arabia and Egypt have criticized the Israeli move and say aid should not be used as a weapon for collective punishment. We have more ahead. This is Bloomberg.
Some of the latest corporate headlines that we're following, and shares of Star Entertainment are suspended as the Australian casino operator continues to try to stave off collapse. The company said on Friday it expected to receive at least one offer to keep it afloat. Without a rescue package, Star has been unable to lodge its financial reports by the February 28th deadline, putting it in breach of Australian listing rules. Chinese AI firm DeepSeek says its theoretical profit margin could be more than 5 times its costs. The startup revealed that it saw a 545% profit margin for its V3 and R1 models during a 24-hour period. But it did add the disclaimer that its actual revenues are substantially lower due to factors such as only some services being monetized and discounts during off-peak hours. More to come here on the Asia Trade. This is Bloomberg. Take a look at how we're tracking when it comes to the start of trading this Monday morning ahead of what is a very busy and potentially week that's full of political as well as a monetary policy risk as well. Taking a look at the Nikkei 225, we're up about 0.7%. We're also seeing some gains when it comes to Australia, although we are seeing the ASX 200 there off those session highs, really culling those early gains to just about 0.25%. Of course, part of the threats this week really is to do with the tariff barrage that's about to be unleashed on Canada, Mexico and China. New tariffs doubling the levy on China, which would apply to roughly $1.5 trillion. And so much of this is going to have an impact on these Asian economies. Shery.
Yeah, we're watching those PMI numbers very closely across Asia. We're getting the Japan Jibun Bank PMI for the manufacturing numbers now at 49 for the month of February. The final figure slightly improved from the initial expectation, but still in contraction territory. It's been in contraction territory since July of last year. Interestingly, we are now seeing it going into expansion for Thailand at 50.6. It's been fluctuating between expansion and contraction for Thailand. When it comes to Malaysia, again, 49.7, still in contraction territory, but very close to that threshold. Of course, Haidi, we've been watching the Chinese manufacturing numbers as well, improving and beating expectations and going into expansionary territory for the month of February as well.
Yeah, still such a proxy when it comes to how we see these emerging market Asia economies progress, right? And we could know more when it comes to the level of policy support for China with the annual National People's Congress kicking off later this week. The economy is showing some signs of sort of nascent momentum, but those tariffs will be testing Beijing's ability to sustain that push. The NPC meeting will be setting the tone for China's economic direction, the spending plans for the next year as well. Our Chief North Asia correspondent, Stephen Engel, has more.
This year's National People's Congress will be tasked with some heavy lifting to counter deflationary pressures at home. Congratulations. Compounded by political uncertainties from abroad.
We think 2024 was the year of understanding the beginning of reflation in China, but it's going to be a long, long battle.
Coming out of the first Trump trade war and then the pandemic, China doubled down on its industrial policies while simultaneously cracking down on the property sector, the internet economy, and of course, COVID. An over-reliance on exports has led to the challenge China faces today: how to address, without stoking excessive debt levels, the imbalances between industrial overcapacity and slumping consumer spending, while also bracing for a potential protracted trade war.
Priority of macroeconomic policies should shift from promoting more investment in the past to promoting both consumption and investment, with more importance attached to consumption.
Bloomberg opinion columnist Shuli Ren says China's households sitting on more than $20 trillion of savings have hunkered down, spending less and creating their own self-care safety nets. Call it economic long COVID.
I think that's a fatal mistake because last year, consumption accounted for only 1/3 of the total GDP growth versus 2018, consumption accounted for more than 2/3. So what happened last year was that basically China managed to grow the so-called 5% only because of strong exports. And that basically put the China's economy in a very vulnerable position when Trump launches his trade war.
December's Central Economic Work Conference essentially set the NPC agenda to approve more public borrowing and spending this year, but authorities have been short on specifics.
I think China basically has no good choices at this point, and President Xi has to make some sacrifices.
Including vows to strengthen China's social safety net by boosting healthcare and pensions to an aging society and middle class that's been hit with massive paper losses on property.
I suspect the government will look at the economic development, look at tariff announcement and responses in the economy and potentially announce more. So basically, I think they need to work hard to stabilize the property market and boost domestic consumption.
The levers for the level of reflation are now in the hands of NPC lawmakers gathered here this week. Stephen Engel, Bloomberg News, Beijing.
Our next guest is not expecting bazooka stimulus from Beijing and says policy positioning will remain in a reactive rather than preemptive mode. Wang is a chief Asia-Pacific economist at Vanguard Group. Really great to have you with us. And we have seen this sort of like pretty cautious, reactive, incremental measures so far, right? And the economy is starting to see some signs of green shoots. How challenging is it for them to be more aggressive, not knowing the true impact of Trump's policies?
Thank you, Heidi, for having me today. I think at this moment, policymakers in China actually face heightened uncertainty, right? It's not just about what kind of policy will be actually implemented, right? Even we talk about tariffs, how much is tariff threat instead of actual that's going to be implemented. There's uncertainty. And also, I think the uncertainty is also about how much impact it is going to have on Chinese economy, right? It depends on, the tariff implemented elsewhere. It depends on the currency moves. It depends on how much China retaliates. So given that, I think, at this moment, China is more like they want to, take a more reactive approach, as you just mentioned, to see, get more clarity. And then they will be, potentially ready to implement more policy support for the down the road. So at this moment, what you have seen is still a continuation of this gradual, gradualism approach in terms of policy support that they have started since late last year.
Confidence, the lacking of animal spirits has really been a key sort of fundamental reason why we've seen the recovery being held back, right? Do you think the renewed support for the private sector, the exuberance that we're seeing in AI and tech, could change that?
Yeah, I think the lack of confidence in the private sector is has been there for quite a long time, right? And I think a lot of the message delivered by the government is not really new. So I think for the private sector, yes, there's a lot of excitement at this moment, but I think a lot, will be need more action, right? Rather than just the words. And also, one thing I was actually saying is that, of course, investors like the green shoots, the hopes in the high-tech sector. But when you think about the macro economy, I would just say, even though those high-tech sector, they could actually revive some animal spirit in those sectors and encourage some kind of investment, but those are not enough to lift up the whole economy and also the overall labor market, right? Especially those sectors are very capital intensive, so they are not going to create a lot of jobs. And that job, better job prospect and wage prospect is really what is needed for broader and sustainable consumption recovery at this moment.
And how much of that depends on the property sector bottoming out, and when could we see that?
Yeah, I think when you look at the Chinese consumer, right, I think what actually drive a sustained consumption up turnaround, there are three things in my opinion. One is really a solid, social security, social welfare system that will help to reduce the precautious saving incentive. And this is where I think the government is indeed trying to, provide more support. Probably we'll hear more on that front in the NPC. And the second, as we just mentioned, is really about for the enhancement in the job and income prospect. And I think, a critical, element is really about the recovery in the service sector, not just in the manufacturing sector. And the third one, I agree. Yes, it is really about the housing market, because 65% of China's household wealth is actually in, property. So stabilization of property price is really critical for our turnaround in consumption.
Looking at President Xi's policies over the years, especially during President Trump's first administration, what can we expect in terms of reaction to the threats, the constant barrage of tariff threats and just tech restrictions coming from Washington? Could these act as a paradox where you're seeing, of course, the potential impact on the Chinese economy, but at the same time lead policymakers to have more aggressive measures to counteract them?
Yeah, I think, at this moment, China, of course, I think they will be happy to start a conversation or negotiation, right? But to a certain extent, I don't think this time, especially if you see a lot of the retaliation from China is actually much more measured and constrained, right? So not that aggressive. So I think that definitely shows China is willing to start the conversation. But I don't think China is in a hurry, let's put it this way, to make concession yet. On one hand, I think China definitely, probably get more confidence in the growth rebound since late last year. And some of the AI achievement probably provide some confidence as well. On the other hand, I think China at this moment they are better prepared than the first trade war, right? So the global supply chain actually has shifted. China has been shifting exports, outside of the U.S. For quite some years. So I think this is where, I don't think China will be in a hurry.
It's interesting, the PMIs really kind of showed a pretty divergent picture, right? There's supply side strength, there's increasing reliance on external demand. The softness in internal demand, I wonder, is that something that policymakers can and should address right now? And what sort of perhaps fiscal side measures might we see?
Yes, I think, you just mentioned about the PMI actually rebounded in February, right? But, January, February number are always volatile because of the Lunar New Year. When you take the January, February average, it is still actually below 50, right? And it's actually weak by historical standard, especially when you look at the service side, actually is much weaker on that front. So I think, when China actually is facing this kind of trade tension, not just with the US, right, but also, with the rest of the world, there are many other countries who worry about China will be dumping their excess capacity or deflation to those countries are also raising tariff on China imports. So, at this moment, I think there is a limit to how much China can export to the rest of the world. So in the end, China have to focus more on the domestic side and see how can we actually boost up the domestic demand. My concern is that some of the achievement in the high-tech area and also the external headwinds will reinforce China's bias to strengthen its self-reliance in the manufacturing and high-tech sector and continue to focus on investment and supply. And that actually would further increase China's excess capacity and deflation. So I think one of the key things to watch in the NPC is really the composition of the fiscal support. How much is on domestic consumption and how much is on investment?
Wang, always good to have you with us, Chief Asia-Pacific Economist at Vanguard Group, as we continue to watch those policymakers meeting this week to discuss economic priorities. Chinese stock investors, of course, will be watching this pivotal week. Catherine Nai leads our Asia stocks coverage and joins us now. So, Catherine, what should traders be watching out for in the NPC meeting?
Hey, good morning. Yeah, this is going to be a really interesting event just because of the turnaround in the stock market this year. I mean, I think about tech, right, as something that I think we're all going to be, and as particularly those invested in China will be, heavily invested in, given the way that DeepSeek has really reignited sort of a valuation re-rating for the entire China tech sector with, the likes of, Alibaba up 50% over the last 30 days or so. So I think that, tech is probably going to be top of mind, and how the government is going to sort of push this sort of tech supremacy. And it's not just AI. We're also looking at things like, digital economy and robotics, which have seen a pretty good, uplift since the Lunar New Year as well. And as mentioned before, I think the property is going to be, the big one here. The property shares have really waned since the beginning of the year, since sort of the stimulus last year. And I think that there's going to be concern in terms of whether there's just going to be any support for housing demand and for kind of a valuation re-rating. And of course, consumer, given the push for more spending and for trade up.
What else could potentially kind of further this rally, right? Because the expectations in terms of what we get from the NPC are always pretty low. But is the private sector sort of AI support stuff enough at this point?
Yeah, I mean, that's a fair point. I think that, there's always going to be a little bit of the expectations and what's going to actually happen are often not aligned. I think that there's going to be a lot of reading through the tea leaves, right? You have to remember that this conference is very much sort of focused on the economy and broad strokes here. So you're not going to get a lot of readouts that are, about adding, TK billion dollars of stimulus to this sector or that sector. But I think that there's, even in the sort of broad tea leaf reading, I think that investors are really going to be wanting to hear very supportive language and very supportive direction for some of these key sectors. I mean, AI is really sort of taken the China market by storm, so to speak, in the last few weeks or so. And I think the leaders have, Chinese leaders have really embraced that. So anything kind of supportive in that direction, I mean, there's still a lot of upside. The shares are still, relatively speaking, historically speaking, very cheap. So, I mean, this could definitely help. But of course, the market is quite dependent on property. And so, the sort of further encouraging signs there, I think that maybe the combination of those really kind of help this kind of world-beating rally that we've seen across Chinese and Hong Kong stocks.
Catherine Nai, who leads our Asia stocks coverage there, looking ahead to the potential impact of the National People's Congress. Coming up next, Prada is said to be moving closer to a deal to buy Versace after agreeing to a price of nearly $1.6 billion. This is Bloomberg. Well, Prada is said to be moving closer to a deal to buy Versace from Capri. Our sources say it's nearly agreed, to a price of nearly $1.6 billion. Let's bring up Bloomberg Intelligence Senior Analyst Catherine Lim. So what do we see as being the financial impact, the sort of strategic impact on Prada if this deal comes through?
Right, Haidi, I think, if we look at Versace and Prada, it's a good fit, for the Prada business in terms of the apparel, leather goods categories. But let's be realistic because Versace is having their own set of problems. It's going to be a drag on the 13% EPS growth that the consensus is forecasting for Prada in the near term. There's an ongoing overhaul that Capri has actually spoken about for Versace since the fall of 2023, and we're probably going to continue to actually see that drag on Versace, and then again weighing on Prada's results in the near term as a result of this deal.
Despite those concerns, when it comes to the deal itself, what are the potential challenges for Prada in the acquisition?
Right. I think if we look at it, Capri in their very recent Investors' Day, and that was just last month, about 2-3 weeks ago, they've highlighted that they are looking to actually return to grow for the brand by the fiscal 2027. And going into the next 12 to 14 months, we're still going to actually see the drag from markdowns, from a reduction in the wholesale distribution, and notwithstanding forex headwinds. So again, there's a whole combination of that together with the repositioning of Versace into what Capri has actually spoken about, a quiet luxury brand, which, I guess, to be honest, I'm just trying to see how Versace emerge from this rebranding over the course of the next 1 year.
Bloomberg's Catherine Lim there with the latest. We'll also check China's largest bubble tea chain as well, Mixue. They'll begin trading in Hong Kong in the coming hour. The company's $444 million IPO was the city's biggest so far this year. Let's bring in Bloomberg News reporter Felipe Pacheco. Felipe, so how important is this debut for Hong Kong's market overall and for the sector as well?
Hi, Shery. Good morning. This is a quite significant deal, as you just mentioned. This $444 million US. It's the biggest IPO here in Hong Kong so far in 2025. But actually, to put in perspective, we've had a few bubble tea IPOs over the past few years, especially since 2021. This is going to be the biggest of them, and this is the largest company within the sector that is actually coming to market here in Hong Kong. We are talking about a company with 45,000 shops, mostly across China, but also in different parts of Southeast Asia, especially in Vietnam and in Indonesia. And this is a sector that's been going through a lot of bumps along the way. Let's say many of the companies that listed, their stocks tanked right after they began to trade. But in this case, we've seen a gigantic demand for the shares of Mixue. This is a market leader. It has the biggest market share for those companies within China, and it's also expanding. The company says that it's going to use the money mostly to deploy in its own supply chain, which is actually very well put together. It has a franchise model that's been doing quite well over the past few years, especially over the past 3 years. It's surged in number of shops. So it's going to be interesting to see how the performance will be this morning.
We know that they're founded in Henan province, but what do we know about the two founders of Mixue who became billionaires with this listing?
Haidi, there's a very interesting story actually behind the names that started the company. It was actually one brother that started in 1997 in Zhengzhou with a shaved ice stall in a street market. After that, they had to remodel the business a few times, let's say, to come up with with the chain that we know as it is today. 10 years after the first brother started this initial shop, he invited his younger brother to be part of the business. He was the one in charge of actually putting together the franchise model. And, well, 20 years after that, we are here, the company is listing today, and the two of them, they're going to own the equivalent to about 82% of the company, and their stake is worth close to $8.1 billion US. If you compare to Howard Spence, for example, the name behind Starbucks, the two brothers behind Mixue are actually richer than he is right now.
Felipe, it seems to be a rather calm day for a stock to start trading. We're seeing broad upside across Asia, but of course that doesn't necessarily tell us what it could mean for stock performance long term. What are we expecting for this company?
That's a very good point, Shery. As I said, the companies that came to market over the past few years, they had not a very, very good performance, especially those that came last year and before. We had another bubble tea company here in Hong Kong, Gumi, that came to market in February. The stock is actually doing quite well, but I think it's very fair to say that Mixue has a very different profile. It's very big, it's very granular, and people are expecting very good performance, not just today, but over the medium term, yes.
Bloomberg News reporter Felipe Pacheco there. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how we're setting up when it comes to sessions, when it comes to Taiwan as well as mainland, as well as Greater China, I should say, coming online there. As, of course, a lot of risk aversion. We do have the NPC getting started this week as well, looking out for more policy support from Beijing.